Traders, Gary Wagner here, just after 10 o'clock in Honolulu, 4 o'clock in New York. It is Friday. Happy Aloha Friday, as we say on the islands. 17th day of July, 2015, and this is the daily report for gold and silver, our weekend review, and what a way to see gold end on the week. We have hit a 5-year low. We're breaking below recent lows that we had last year. We've talked about this over the last couple of weeks, that there was the real high probability of tremendous pressure within the market, especially due to a strong U.S. dollar. When we look at our current print, 1132.50, that puts it off roughly $11 on the day, almost a full percent. It broke to a low of 1129.60 and a high of 1144.50, putting it down, as I said, about 1% on the day. Silver also selling off fairly dramatically. However, in terms of percentage drawdown, only off by 0.89%, 1485 down 13 cents, low 79.50, the high 15 even, or 15 and a half a cent in terms of the high. We'll look at silver in a little bit. So traders, first chart I want to view on today's show is a half-a-day Japanese average chart. We'll try to convert this into a standard candlestick, but there's a couple of things that are quite evident. First of all, this week has just seen an utter meltdown in the gold market, in which we've seen 5 consecutive days in a row where we've had lower pricing. You can absolutely see how that really is visually illustrated when we look at these half-a-day candles. Body size remains strong, first. Secondly, absence of all the upper wicks. And what that says is a market is going down, in other words, red candles, is that it opened below the midpoint of the prior day candle, and it at no point traded above the midpoint of the prior day candle. Otherwise, you would get a tail from the end of this body here above it. And then lastly, what it tells you is that on each and every candle, it closed below the midpoint of that day. So you've got a strong trend in play, and the trend is obviously a bear trend to the downside. Second thing that's absolutely noteworthy, and this is a couple of things we want to look at before we start pulling up longer term historical charts, because what we're going to see is we are in new territory. But it's this particular line in the sand that was breached today. We closed well below it, as I said, 32.70. The reason this says 36, it's looking at the midpoint rather than a true open and close. That's one of the reasons we'll want to convert it. But we broke through this point and broke through it significantly. So traders, this is really where you'll see the tremendous sell-off that today's market trading brought us. This, of course, is that line in the sand. I said that a break below this would probably signal this market moving to about 1080. That is still our call. I had hoped for some sort of a bounce this weekend. I have to apologize. We could have entered at any point, but it is rather rare to have 5 consecutive days in a row in which you've got lower pricing. We got that. We are at a 5-year low. We're trading at 1132.80, and most importantly, we have broken below this critical level of support. Traders, to give you an idea of how strong and consistently lower this market has been throughout the week, we're looking at a daily chart, standard candlestick format. We have a basic channel line, a linear regression that we've put in here. And in terms of the marketplace itself, we are now at the bottom of this channel. But at the same time, we've broken through all of our significant levels of critical support. That's why we're at that 5-year low. We'll have to look at a weekly chart really to see the strength of this move down and where the closing price has ended at in relationship to historical data. MACD, powerful. Definitely, we've got these lines moving apart, which tells you, just as with the Japanese average charts in terms of body size, gives you a defined strength in the market. The fact that the moving averages are moving apart is significant in that is telling you the same thing. There's plenty of power left in this trend. Momentum is definitely shifted to the downside, and we're looking at a dramatically different market than we were 1 month ago. So traders, this really is significant in terms of just the visual observation of where this market closed at. This, of course, is our closing price, roughly at 31. We have to draw this across. I will do it as straight as I can, but you can absolutely see on a closing basis, that is, because you did have this low come in at 31. We talked about that over the last couple of days, but we've never had the market close at 31, at least not until we go back in the chart into 2010 prior to the move up to 1920 in terms of market highs. So that's significant. And what that really does is it gives us what I'll call a good news, bad news scenario. And in that scenario, I'll start with the bad news since that's the prevalent, more short-term view of the market. As I said, on a closing basis, we've gone to a 5-year low. We have not seen this low since 2010. That is absolutely significant. What that tells me, though, is that we have more downside pressure before we see any kind of real potential bottom in the market. In other words, it'll probably go lower before it finds a bottom and moves up. It'll be worse before it gets better. That's the first thing as we look at this market. Second thing is our target for where this market could go. And really what we have been using to basically plot our targets are Elliott wave extensions of the current wave that we are in. Now, as I said, we're looking at weekly chart, so this is long term. What we're plotting right now is a fifth wave. That fifth wave has been prevalent in the market for the better part of 2014, and on our shorter term studies, as you know, our basic Elliott wave is looking for a move down approximately to 1083. However, based on our longer term studies, meaning when we're doing our Elliott waves off of our weekly, our target changes to about 1040. So even lower in terms of a potential possibility. So as I said, there's bad news and there's good news. The bad news is we're probably going to see this market break below 1100, as low as 1140. To maybe 1040 to maybe 1080 in terms of a potential bottom in the market. So traders, with all of that in mind, I said it was good news, bad news. I've presented the bad news. Well, what's the good news? Well, the good news is that at some point wave 5 will terminate. When this, and this of course is our major count looking at a weekly chart, and the key to this, of course, waves 1, 2, 3, for our fifth wave down, the key to that, as far as I'm concerned, is at the point in which it does bottom, we will then have completed this bear cycle with the distinct possibility of re-entering a bull cycle. Now, this is not something that I anticipate happening over the next couple of weeks or couple of months. This is a real long-term look at the market, but we are at a spot right now, first of all, if you look at the Fibonacci retracement, this is a 61% retracement of the entire move up starting in 2008 when gold is trading below 700, trades all the way up to, of course, 1920, our record top. Then we go into our bear count. If you notice, that's exactly where we close. So this is a significant long-term view and also a significant long-term study. As I said, I don't expect it to find support here because I don't think that we have completed a fifth wave, but you can see just how critical this number is in terms of how it continues to show up in different studies of different time cycles. Now, of course, when we look at this really long-term study, we see a market that this is the 75% retracement, 969, and that also targets with this study's projection of where wave 5 could go. And it's simply based upon a couple of Elliott wave models. In this particular model, it's simply looking at wave 5 and comparing it to wave 1, but it's also looking and comparing it to wave 3. So that's pretty significant. But the good news, as I said, is that at some point, of course, we will see the termination of this bear move. Let me go ahead and compress this just a little bit. And at that point, we have a distinct possibility, whether it's at 1080, 1040, or even down in this area. This would be the lowest I believe it could go on a technical basis. But then we've really weathered these last couple of years in which we've seen this market dramatically decline from incredible highs to now incredible lows. So traders, we've spent a lot of time talking about the current price of gold and really some fairly bearish projections in terms of where I thought this market could go. How does that really translate into the language of silver, meaning where we're looking at silver to go? And I have to say that if we have these markets moving in tandem, which we pretty much do 80 to 90% of the time, we're going to hit some new lows in silver if in fact we see gold break below 1100. If in fact that's the case in terms of where I think the market could go to, we really have to start looking historically at some long-term studies. Let's go ahead and kind of compress this. And when we do, realize we're looking at gold pre-2010, we're going to have to look at silver pre-2010, although we're not quite there. 1483, if we go straight across, we are very, very similar to gold in that we hit this low. This was the most recent low in the market, but on a closing basis, this is the lowest we've seen silver since 2010. It matches up with this bottom here. If this does not hold, which I really don't imagine it will, our real projections got to be back to about $12 an ounce for silver. Again, these are long-term studies. We're using weekly charts for these particular studies. This is not something I'm looking at in terms of unfolding overnight. But I have to tell you what our studies are pointing to and the conclusions that we can derive from the data that we have available today. This has been Gary Wagner, wishing you as always good trading. We will talk to you tomorrow, on Monday, for another daily update and review. Bye-bye.